Hello, welcome back to corporate finance class. And today we'll be talking about financial analysis and planning. It's actually going to be first series and second series, which this module attends to the first series, and the other one will be in module 3. Now, for these aspects, we'll be talking about financial statements and also ratio analysis briefly. We'll just give an introduction into it. Better understanding has been provided in the notes as for those that are enrolled. And looking at these two um, components of corporate finance is very, very important. When we talk about financial analysis, it's actually the foundation of corporate decision making. It's the foundation of corporate decision making, and it provides tools to access a company's past performance, manage present resources, and prepare for future financial needs. And this process transforms raw accounting data from financial statements into actionable intelligence. And at the very center of the financial analysis is the interpretation of financial statements through ratio analysis. And you can see that these two are interwoven. You need the financial statement to be able to perform ratio analysis. And ratio serves as a diagnostic tool that highlights profitability, liquidity, efficiency, and solvency, offering managers, investors, and creditors insight into a firm's overall health. And by dissecting income statements, the statement of balance sheet, statement of financial position, and the cash flow statement, financial analysis transform raw accounting data into actionable intelligence for both short-term and long-term decision making. We have the core financial statement, 4 core financial statements that are well recognized. And looking at the financial statement, they are the formal records of a company's financial activities, all that was performed, the transactions and everything that are performed by a company, and they are indispensable tool for evaluating the profitability, liquidity, and operational efficiency. And just like I said, we have 4 major financial statements. The first is the income statement, which is known as profit or loss account before. We also have the statement of financial position, which was balance sheet before, and we have the cash flow statement, and we also have the statement of change in equity. For income statement, it actually shows the performance over a period, the performance of the company over a period. For the statement of financial position, it provides a snapshot at a specific date. And for cash flow statement, it shows the company's cash inflow and outflow. And statement of changes in equity, it summarizes movement in owner's equity. We will look at each of these one after the other. For the income statement, it actually answers the critical question, is the business profitable? So as an investor, if you have to invest in a business, it helps to be able to answer the question, is the business profitable? It summarizes revenue, expenses, and net profits or loss over a specific period, maybe year or whatsoever the business or company is actually working on. And key components of income statements are the sales revenue, which talks about the total income from sales. We have the cost of goods sold, which is the direct cost of production. We have the gross profit, which is revenue minus the cost of goods sold. We have the operating profits, which is the profits from core operations after deducting operating expenses. And we have the net income, which is profit after tax. And this is the bottom line of all profits remaining after all expenses and taxes are being deducted. And this is where income statement or profit and loss account actually ended. For the statement of financial position or balance sheet, it actually provides a snapshot of a company's assets, liability, and equity at a specific point in time, and it is guided by the fundamental accounting equation, which is asset is equal to liability plus equity. Asset is equal to liability plus equity, and the key components, just like we've said, is the assets, which is the resources controlled by the company that are expected to provide future economic benefits. Also, the liability is the obligations. The obligations the company owes to external parties in terms of debt and some other as such. We have equity also as another component which deals with the owner's residual interest. It's the owner's residual interest in the company after all liabilities have been deducted. This is actually the components of the statement of financial position. For the cash flow statement, this statement shows how a company generates and uses cash across three main sections. And when we talk about these three main sections, they are the operating activity, the investing activity, and the financial activity. It is crucial for accessing a company's liquidity as a profitable company and still face cash shortage. And for operating activity, it shows the cash from core business operations like sales and payment of to suppliers. For investing activities, it shows cash used to buy or sell long-term assets such as machinery or property. And for the financing activity, it actually reflects the cash related to raising capital and repaying investors and lenders. Lastly, the statement of change in equity, and this is a statement that provides a detailed summary of the movement in a company's equity during a specific period, and it acts as a bridge connecting the income statement and the balance sheet. And the key movements in this key components are: one, the net income or loss, which increases or decreases retained earnings. We also have the dividend paid, which reduces retained earnings as profits are distributed to shareholders. And we also have the new share issued, which increases share capital as new funds are invested. Now moving to the ratio analysis. What is ratio analysis? Ratio analysis is a key diagnostic tool that uses data from financial statements to evaluate a company's financial performance, and it simplifies complex data and allows for comparison across time or against competitors. And ratio analysis is generally divided into four categories. The first is the liquidity ratio, which talks about the ability to be able to meet short-term obligations. And profitability ratio deals with the efficiency in generating profit. It helps investors to be able to know the efficiency in a company having to generate a profit. Also, the efficiency ratio deals with how effectively assets are used to generate revenue. And lastly, for the solvency ratio, deals with the long-term financial stability and reliance on debt of such a company to be looked into. Practically taking this, looking at current ratio, which is a type of liquidity ratio, we see that in order to calculate the current ratio, we have the current asset divided by the current liability. And if the ratio brings it to, if the current ratio is actually 2, it means that the company has 2 naira in our current asset for every 1 naira that is being owned. And same for gross profits, which is under the profitability ratio, and this can be calculated using gross profit divided by sales revenue times 100. And for example, a 40% margin means the company retained 0.4 naira, 0.4 naira of from each 1 naira of sales after production cost. And another is inventory turnover, which is for efficiency ratio. And for this, it is cost of goods sold divided by average inventory. Average inventory, and to get the average inventory is actually the opening inventory plus the closing inventory divided by 2. And example is a turnover of 3 times means inventory is sold and replenished 3 times a year. And the debt to equity ratio, which talks about the solvency ratio, can be calculated using total liability divided by shareholders' equity. And example of this is a ratio of 1 indicates equal financing from debt and equity. In conclusion, having mastery of financial statement analysis and ratio analysis is essential for understanding a company's health, stability, and efficiency. And these analytical tools are not an end in themselves, but a critical prerequisite for sound strategic planning and decision making. And so by interpreting raw financial data, managers can gain insight into cost control, resource allocation, and overall financial health of an organization. Thank you.